Characteristics of an insurable risk. Number one, there should be a large number of homogeneous risk exposure units. The insurance company must be able to calculate the number of losses it will incur from the total number of risks it insures. So what is needed is a large number of similar risks so statistics can be developed to determine an accurate probability of loss for each risk being evaluated. Insurance is based on the law of large numbers, which means that the greater the number of exposures, the more closely the actual results will approach the probable results that are expected from an infinite number of exposures. So, for example, life insurance companies have accumulated information over the years that enables them to develop mortality tables that reflect the expected mortality for a given type of risk. They are able to do this because of the large number of lives that they have insured over the years. Medical, dental, disability, and life risks all require a large number of cases to determine proper premium rates. Those plans with large numbers of homogeneous risks can be experience rated. This means the premium will be calculated with the data from the plan experience itself. Number two, the loss should be verifiable and measurable. It's important that an insurance company be able to verify a loss and to determine the financial loss that's involved. There are certain risks that pose no problem in determining if a loss has taken place. For example, a fire, a windstorm, or an automobile accident. There are other risks, however, that are harder to evaluate, such as a claim for theft of money from a home. Did the person actually have the money in the home at the time of the theft? Are they actually telling the exact amount of the money that they had in the home? Those type of claims are a little bit harder to verify, and that way, these type of things may not be approved or insured. So employer benefits are subject to the same type of problem. Death claims and retirement benefit claims probably would be the easiest, which to determine whether the loss has taken place or not. Now, disability income claims are a little bit more challenging because you actually have to determine, is the person really disabled or are they lying? So these pose higher risks of being insured. When an employee benefit loss is difficult to verify or measure, the insurer may attempt to overcome the problem through several methods. Policy provisions are helpful in such situations. Benefit maximums, waiting periods, pre-existing condition clauses, alternate medical verification, required second opinion on certain surgical procedures, and hospital stay monitoring are a few of the provisions that help in these situations. Number three, the loss should not be catastrophic in nature. 3. The loss should not be catastrophic in nature. A serious problem occurs when a large percentage of the risk insured can be lost from the same event. Assume a fire insurance company insured all of its risk in one geographical location. A serious fire could result in catastrophic losses to the company. This did happen in the earlier history of the fire insurance. Fires in London, Chicago, Baltimore, and San Francisco resulted in insurance company bankruptcies and loss of confidence in the industry. It became obvious that a geographical spread of the risk insured was essential because a concentration of losses from one event could seriously impair or even bankrupt a company. There are situations where it's almost impossible to obtain a spread of the risk. In such cases, insurance becomes difficult or impossible to obtain. For instance, flood and unemployment losses would be examples. Unemployment can cover wide geographical areas, and a geographical spread would not help prevent a catastrophic loss. The same could be true for flood losses. The federal or state government might issue this type of risk, but it would be necessary for it to subsidize the premium rates to make them affordable. Employee benefits are seldom subject to problem relating to inability to get a geographical spread of the risk. Benefit plans often insure life risk, hospital and dental risk, and disability income losses. For the most part, these type of risks are not subject to catastrophic loss due to geographic location, but examples can be imaged in which catastrophic losses might exist. The possibility of a plant exposure or a poison gas leak causing a large number of deaths or medical losses, or a concentration of certain diseases because of the exposure to certain elements that are indigenous to a specific employee group theoretically exist. Usually, however, this is not an important consideration in underwriting typical benefit plans. Policy limitations, reinsurance, and restrictions on groups insured all can be used to minimize the problem to the extent it exists. Number 4, the chance of loss should be subject to calculation. Chance of loss should be subject to calculation. So data on both the frequency of losses and the severity of the losses must be available to determine the loss portion of the premium. This often is referred to as the pure premium portion of the premium. Essential to the pure premium calculation would be a large number of homogeneous exposure units, as previously discussed. If an employer is large enough, the plan losses alone could be used to determine the pure premium portion. The meaning of large depends upon the type of risk involved. At least several hundred employees probably would be needed for full reliance upon the data. 5. The premium should be reasonable or economically feasible. An insurance company's expenses not related to the losses covered by the pure premium must be added to that premium to obtain the total premium. The expense portion may be referred to as the loading associated with the risk. The pure premium plus the loading would make up the total premium to be paid by the plan. Why would a premium be non-competitive? This could happen for any number of reasons. For example, a plan could be populated by a high number of older employees. The resulting rate may mean that the younger employees can find lower cost insurance outside of the plan. Also, the employer may not want to pay the needed premiums. Other reasons for non-competitive plans could be poor loss experience from a high number of sick and disabled in the plan, or a plan having specific benefits that have resulted in high loss payout. Failure to keep the average age of the members in the plan low or higher incidence of illness could be the reason. Constant review of benefits, benefit levels, employees covered by the plan, and competitive rates for alternative plans must take place. It has become common for plans to move away from first dollar medical benefits and to incorporate deductibles, waiting periods, and other cost-saving features.